Joining us now is Schwab's Kathy Jones, Morgan Stanley's Jim Karen and Jim Bianco of Bianco Research. Kathy, I'm going to go through each and every one of you to get a reason as to why we've had such a big downside surprise early this morning. Kathy, first to you.
Well, there were a number of factors at play. Seasonal adjustment, the one-off, the shortages in the chip sector, keeping some of the factories closed. But I've thought all along that we're really not going to get a robust rebound in jobs until we get the schools open again. You have a lot of parents at home working, are trying to work while they're trying to balance virtual school. They can't get full-time or affordable or available contingent health child care to allow them to go to work. And so for some, they just have to wait it out. There's not a lot of choices. When you look at the state and local government jobs, a lot of them are education related. It's not just teachers. You've got food service workers, bus drivers, crossing guards. It multiplies, has a lot of tentacles. So I think it's going to take some time, but I think by the fall, we'll see a big improvement.
Jim Karen, your take.
Yeah, so I agree that we are going to see an improvement in jobs. But look, I mean, when you have a miss like this, I think everything has to be put on the table at this point. We had a very, very strong March jobs payroll. So a lot of the reasons that, many are using to sort of ignore this current weakness, in the April payroll number, might not hold up to March. And I know there were I know there were differences with seasonality and things like that. But, I think everything needs to be on the table. So whether it's unemployment benefits, whether it's, going back to school and figuring out, when people feel more comfortable going back into the workplace, all of these things are factors. The key here, though, is that the data right now is extremely noisy, and the risk that we all run is extrapolating noisy data points. It was wrong to extrapolate the March strong payroll number into a strong April number. It may be wrong to now take a weak number that we just got today and extrapolate that into the future as well. So very, very noisy data, and we're working out of sample given that we don't have many pandemics to really go on and see how economies reopen. So that's the key issue here. I think the data is noisy, and I don't really think it's anything more than that. There's nothing conclusive here in my view.
Jim, 2 points there, and I want to pick on the second point in just a second. Let me get to the first one, what underpins this miss. Jim Bianco, this is from Luke Cower of UBS. He writes on Twitter, Luke who? I know that's what you're thinking, formerly of Bloomberg, of course. Luke Cower of UBS, now of UBS, send the following on Twitter. Reminding myself that if I was 750K off actual job growth, I should neither have a high degree of confidence that I can quickly flag a narrow cause for why the forecast was so wrong, nor should I remain close-minded to causes, even if they don't really ring true to me at the time. Jim Bianco, have you got an open mind as to what's caused this?
Yeah, I mean, I agree with a lot of what was said before, but let me throw out one other argument. The wage numbers were very high. If you go back and you saw the ADP number was a miss earlier this week. The ISM numbers were a miss this week. The ISM numbers show prices paid was very high. So let's just cut to the chase. People are going to have to start paying more for labor, and we're going to have labor wage inflation. And the reason that they're not getting it now is that they're rationing their labor and they're not ready to step up and start giving increases. We've started to see anecdotally stories that you're getting paid to go to interviews, you're getting $300 signing bonuses if you're at the lower end of the wage scale. We're going to probably see more of that. We're probably going to have to see wages go up more. We're going to see inflation, and then we're going to start to see jobs come back. But right now, they're just not ready to pay enough to get people back to work. The shortage is also having a big issue, too. Manufacturing was down 18,000. The chip shortage in the automobiles manufacturers being attributed to that. And transportation and warehousing lost 300,000 jobs. A lot of those jobs are idled because of the because of the supply constraints. Again, you resolve that by raising prices. Just start paying more for everything, and we'll start getting the supply chains moving one more time.
The solution could be the problem. Kathy, your response to that?
I think there's a lot of truth to that. I do think we're going to see higher wages, and I do think we'll see somewhat higher inflation. I don't think all of it will be transitory. I think there'll be some that's sticky because by and large, we're seeing a pretty major shift in the supply-demand dynamic. So I would agree. We'll start to see higher wages, which is the natural response to the shortage of supply of workers.
Jim Karen, your view?
Yeah, so I'm a little bit skeptical. I know we have about 8.2 million jobs that we're short right now. Those jobs need to come back, but will they all come back? Will we get all the pre-pandemic jobs coming back? A lot of corporations have changed. They've taken advantage of technology. Some jobs are just not coming back. So to some degree, there may also be a skills mismatch, meaning that the supply of labor coming in initially might be a little bit smaller. This could lead to a slower fall in the unemployment rate initially, but I do think that it could bring wages up, going forward. So that could be a point of inflation pressure, at least over the near term.
Jim Karen, you made 2 points. I want to pick up on the second point that you made a little bit earlier. You talked about the noise in the data. Goldman touched on this a little bit earlier in the week in a piece of research. The amount of dispersion between the data, the noise, the volatility, that range even before the print was 2.1 million at the high end, 700K at the low end. What I'm trying to understand now, with a big miss like the one we've just seen, and when you use the word noisy, how sensitive rates will be to incoming data in the weeks and months still to come. Jim Karen, less sensitive or more sensitive?
So I think it's going to be more sensitive, but the issue, though, here is that it's going to be more sensitive and attach itself more to what the Fed has been saying about being patient. So I think there's going to be a little bit of a reluctance for the market to embrace this high inflation thought process right now and have rates move higher, at least in the near term, very, very quickly. I think the markets may attach themselves to the Fed saying, look, it was probably right to be patient. But again, remember, noisy is noisy, which means that the May payroll number might be 2 million. I'm not making a forecast, but I'm just saying, I'm just throwing it out there. It could be a significantly big number, in which case we're not going to be talking about the April number. So we have to be very, very careful about what time frame we're talking about.
Well, we got immediate reaction from the Federal Reserve. We heard from Minneapolis Fed President Neil Kashkari 10 minutes after the jobs report, 5 minutes even. Take a listen to what he had to say.
My friends on Wall Street, and I have a lot of them, I hear from them all the time complaining about the Fed's policies that are mucking up their trading strategies. I have zero sympathy because there are still 8 to 10 million Americans who want to work, who ought to be working.
It's Neil Kashkari there, the Minneapolis Fed President. Jim Bianco, for no reason at all, I turn to you, sir. Let's talk about this. The Federal Reserve and Neil Kashkari. No sympathy for anyone on Wall Street. That's OK. They believe there's a lot of work still to be done. We all agree with that. 8 to 10 million people still need to come back into the workforce. What remains to be seen, though, is whether a QE program at $120 billion a month at the moment, Jim Bianco, helps get that done.
Yeah, that's really the big question as to what kind of effectiveness that program is having in creating jobs in, let's call it, the real economy. But I understand why a lot of people on Wall Street look at that $120 billion a month and say that it makes their job different or more difficult or maybe even easier, depending on where you are on Wall Street. But that's really the question that the Fed has to ask themselves. Are they helping to create jobs, or are they fostering an attitude about inflation that may come back and create more inflation and be counterproductive at the end of the day when it comes to trying to get us all back to full employment? I've not heard them articulate a good reason why, with the booming housing market, for instance, we still need to buy $40 billion worth of mortgages a month. Mortgage market seems just fine, and yet they continue to plow money into the mortgage market. Now, are they really helping the situation by creating jobs or potentially creating problems down the road?
Does it validate the Fed's current stance, Kathy Jones?
Well, I think so. I would agree that when and if they begin to taper, they'll probably start with mortgages because of the reasons cited. The housing market's in good shape, and they're a huge player in that market. But I would point out that QE periods have actually coincided with rising long-term rates. So even though they're taking duration out of the market and signaling a very dovish stance, that's almost fueled inflation expectations or growth expectations. And so it's hard to argue that what they're doing is really damaging in terms of fostering, this narrative of fostering, well, you have to do something else with your money. Sure, the zero interest rate policy is contributing to that, but I'm not sure that the QE is contributing to that to the extent that people think it is.
I'm often guilty of being seduced by the should-shouldn't debate with the Federal Reserve, and I always try and take it back to basics. It's the will-won't that matters here, Jim Karen. I wonder, after the payrolls report we had earlier this morning, whether it just takes the taper debate away from the June meeting, pushes it back to July again.
Yeah, I think it can be helpful in doing that. Again, it's also going to depend what the next payroll number also looks like. But I think the Fed's argument right here, we have to look through the lens of their policy reaction function. And one of the primary components is that they believe inflation is anchored. It's not become de-anchored. So they're willing, I think, to press this a whole lot further. The other component is financial stability. If they believe that their QE policies of $120 billion per month start to create, instabilities within the financial markets or potential for that to happen anytime near term, then I think that they also react. But at the moment, I still think that they believe that inflation's anchored and that they're going to probably stay the course. So I think it does push things back from June in terms of announcing tapering. My best guess is that they do it at the earliest at the Jackson Hole in August.
Jim Karen, Jim Bianco, Kathy Jones, sticking with us. We'll talk about the market in just a moment. The auction block next. The rush to junk continuing with yields plunging to fresh all-time lows. That conversation next. This is Bloomberg.